What's going on, everybody? Lately, I've been getting some questions about the difference between a traditional retirement account and a life insurance contract, and particularly an index universal life policy. So, I have 5 key differences that I want to share with you today, and hopefully, that will clear up some questions and give you some answers. So, the first thing I want to mention is the contribution. The contribution in the traditional retirement account is limited. There's a cap on, there's a maximum value that you can put in each year. So you can contribute a certain amount each year, whether it be an IRA or a 401k. They give you an amount that you can put in there. Whereas in an insurance contract, there's no limit to how much you can put in there based on it's based on the amount of insurance that you're purchasing. So that amount is based on that, as long as it's structured correctly for the amount of insurance that you're purchasing. So that's a different, there's no cap over there. The next thing is liquidity. With a traditional IRA or 401k retirement account, it's not very liquid. If you take out any money before age 59 and a half, you're going to get a 10% penalty in addition to any taxes that you would have to pay. So it's a 10% penalty. Now, there are instances where you can borrow from it. You can do a loan in emergency situation, but those circumstances are limited, and the amount that you can borrow is also limited. So not very liquid if there's restrictions on what you can do. As opposed to an insurance contract, very liquid. You can take as much money as your cash value would allow you to take, and you can borrow from that anytime, okay, for whatever reason. So it's very liquid. You can access your money quickly. Safety is the next thing that I want to talk about. With a traditional retirement account, it's invested in the stock market. So therefore, even though you can gain when it does perform well, but if it does perform bad, you can lose money. For example, in 2008, when it dropped almost 40%, a lot of people lose a lot of money. So you are open to the volatility of the market, right? Whereas with a index universal life, it's very safe because it's tied to an index, for example, the S&P 500, but it's not invested in the stock market. So therefore, when the stock market, when the index does well, you can participate in the gains. However, if it doesn't do well and it goes down, you don't lose anything. There's a floor of 0, so you lose no money. So you participate when it does well, and when it goes down, you lose nothing. And your principal is protected for every time you gain. So if you had 100,000 and you gain 10,000, your new principal is 110. The 110 is what's going to be protected. So very safe vehicle. The next thing is fees. At the beginning of the contract, the insurance policy is usually more fees, because at the front, for agent commissions and administrative fees, most of the fees are at the beginning, whereas with a traditional account, the fees are generally based on the account value. So if you had $1 million in there, then your fee would be 15,000, right? So it's less at the beginning because it's based on the value. However, at the end or later on, years down in the policy, the insurance contract could be less, even though insurance typically are going to be more expensive when you're older. However, structured correctly, your cash value that's billed, that's accumulated, is going to be close to your death benefit. So the insurance company is going to be responsible for insuring you for the difference between your cash value and your death benefit. And if they're close, then it's going to be a lower cost. Whereas, again, the fees for your account, your retirement account, is based on the value. So if they charge 1.5%, if you have 2 million in the account, that's going to be 30,000 automatically. So the fees are different. The next thing is taxes. The taxes in a retirement account is deferred, but but you got to pay it later on down the road. So when you pull money out based on what you've gained, you're going to be taxed, and when it's transferred to your heirs, it's also taxed. Whereas in an IUL, the income, it grows tax free, and when you pull out money in the form of loans, no tax, and when it's transferred to your heirs, no tax as well. So in this case, it's not just tax deferred, it's actually tax free. Whereas a retirement account is tax deferred. And typically when you're older, there's less write-offs that you have. So therefore that automatically puts you in a high income tax bracket. So hope that answers a lot of questions. As always, if you guys have follow-up questions, reach out to me, make a comment in the comments below. And based on the information I gave you, that's all facts, by the way, factual information based on rules, laws, IRS codes. It's based on those things. So I didn't make those rules. Those rules were in place for these particular vehicles. So those are factual. You decide based on the information I gave you. You decide which one sounds better to you. All right, I'll let you make that choice. As always, you got any questions, let me know. Tap in.